Hello and welcome to Quarterly Context webinar for the fourth quarter of 2016 for clients and friends of the advisory group and WealthStep. Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns to help both our personal wealth and institutional clients achieve their goals. We try to keep these meetings to about 20 minutes, and we'll circulate a video link should you like to review some part of it again or pass it on to someone you think we can help like we've helped you. And if you have any questions, please submit them to the answer box, and we'll check as we go along, but in general, we'll address more questions towards the end. So let's get started. As a high-level reminder, it's always important to keep an eye on what you can control, things that matter, and what you can control in terms of moving your own needle. We'll talk more about that later with regards to the capital markets as well, given some updated capital market expectations that happen always at this time of year. And we'll revisit that theme as well. So for many, whether it's a retirement plan, helping participants, a personal wealth client, or foundation endowment, they're oftentimes short-term and long-term goals and the ideal versus acceptable. And so the clearer that picture is, the more we can specifically help you achieve those goals. In terms of markets, for the quarter, relatively solid, despite what many people thought would be a different market response with the election outcome, and was up 4.2% and up 12% for the year, so fairly strong. Higher than expected returns relative to long-term and projected averages. Across the board, for the quarter anyway, the numbers were negative elsewhere in terms of developed stocks being down a hair, emerging stocks being down a bit despite being up 11% for the year, and so forth, as we see. And bonds with an interest rate hike and expectations of inflation increasing, which can influence the speed of rate increases in the future, helped pull down bond markets a little bit. And as we've been talking about for a while, that's not unexpected. If we take a peek at news for the quarter, there are always a number of headlines, some of which bounce markets around, but in the long run tend not to have a major impact, whether it was the Paris climate deal shift or Trump winning the election, the dollar reaching a new high, or a new 14-year high at least, Italy and their referendum defeat, which continues a populism trend in Europe as well in terms of protectionist, and so forth. A number of factors that will move the markets up and down in the short run, but we encourage you to keep a longer-term perspective, because you can look at a chart like this for any given quarter going back, and the long run is what matters most. If we look at an economic snapshot, GDP was revised up a little bit. That helped push some of those numbers we saw a moment ago. Fed raised rates into a range of 0.5 to 0.75%. The bank, in Europe, essentially rates came down a little bit to help stimulate. In England, that was the lowest in 332 years, so that's a notable time. And more recently, the Fed has stated, quote-unquote, considerable uncertainty about the expected impact of Trump and the new administration's policies on the economy, so that may lead to higher volatility. Uncertainty always generally leads to more volatility. We'll see where that goes. If we look at unemployment, increased a little bit. Two maybe positive highlights: that wage growth crept up. However, that can also lead to a tightening labor market. And interesting statistic we saw that this was the 75th straight month of that the U.S. added jobs, and that's the longest stretch since 1939. So the overall trend is strong, and as we've talked about before, in slow, low inflation expansions, it tends to stretch out for a while, and that's certainly what that feels and looks like now. Oil continues to be bumpy, but is now not too far off the range where where the Saudis and others can minimize unrest in their countries, and so the different pressures on oil prices seem to be causing it to hover around that space right now. In terms of the long-term perspective of where the markets are, this blue line reflects the global market financial crisis crash and recovery since then. These are on after inflation numbers, which is why the blue line is ahead of the others more considerably, which is really what matters, because it's the after inflation returns that you can actually really eat, quote unquote, or so to speak. And things have cooled off and gone sideways for a couple of years with a little bit of recent uptick. That in some ways suggests that there is more sideways to go to get back to this dotted line, which is a rough approximation of the long-term average. So we'll see where that goes. So some volatility may be on the horizon. It's hard to say when or what might trigger that. This is the time of year when we do a bit of a look back regarding 2016. If we see the 12% return shown here, puts us in the part of the histogram here that goes back 228 years, showing where the yearly returns fell, and it takes a fairly bell-shaped curve here, so statistics continue to apply and be relevant. If you look back at the last 8 years or so, only one return that was negative, that was 2008. So have been relatively strong with a few mediocre returns along the way, but more than not, returns have been considerably above the long-term averages and considerably above the projected returns, which would be closer to the 7 to 8% range, and maybe even a little bit lower that in terms of upcoming projections. So we'll talk more about that later. It gives you some perspective. Last quarter, we showed this chart that you can just see the colors of here on the left, which showed that the party in power in the U.S. has relatively little impact on market returns. In general, there's no clear pattern of which party does better or worse, and we mentioned that what has a bigger impact is the Fed on rates, and a few clients said, well, it's be interesting to see what that looks like in terms of the Fed rates versus the market. So here you go. We love that kind of feedback. It's helpful for us to show you what you'll find interesting, and we find it interesting too. So looking back to 1960, you can see the blue line just charts at any given point in time what the rate was, the Fed funds rate on the left axis, and on the right axis shows the cumulative return of the S&P. So the one thing is, because of the nature of the cumulative nature of the chart, it tends to exacerbate visually what happens in more recent periods. But if you see, as rates are generally going up here, the market cools off. As rates come down, the market rises. As rates go up, the market starts to cool, and so forth. A more dramatic rise in the 70s to help rein in inflation during the Paul Volcker Treasury period. That led to markets cooling off a little bit. And really the big pattern since then is about a 30-year period where rates have essentially been on a bumpy ride on the way down. That's part of what has pushed up bond prices and returns fairly systematically for a long time, and is why we've been talking for a while about investors they shouldn't expect that level of return moving forward. Now, with low inflation, the after inflation or real return may not be too far off some historical numbers, but it's important to keep all of these elements in perspective. But basically, when you can see there's a pattern between rates and the market, and so we'll see what, as usual, what happens next. In terms of economic patterns, also taking a broad look, so wage growth has been improving, but starting to cool a little. Unemployment still hovering in that same 4.6, 4.7 range. Inflation still hovering at a relatively low rate. Consumer sentiment, however, has pushed up a bit, and consumer sentiment is sometimes an indicator that there's potential strength in the market, because people tend to, especially when housing prices are up and their 401k and other accounts are up, that creates what's called the wealth effect, that people are a little bit more willing to spend then. Of course, that can go the other way when markets cool off a bit. In terms of valuations, what are the, as measured by the price-earnings ratio, which is a way to see whether individual stocks or companies' prices are under or overvalued. And excuse me, while this is an inexact science, you can see that the blue dots here, or the dark dots on the blue bars, indicate the current price earnings ratio of different segments of the market, whether it's the U.S. large cap, small cap, and so forth, relative to recent history of the past 10 years or so. And generally you can see that market valuations are relatively high, which is sometimes a precursor of additional volatility. Are less pronounced in emerging markets, which have had a bit of a tough time in the last year or so, although had a strong last year, but prior to that, a little bit of, certainly some bumps along the way. And while energy is above the market, the upper range is so large that that might not get to be considered to be overvalued given where current prices are. If we look at the quality thermometer for the quarter, we can see that, and for the year, that in general, quality did better, especially in a more pronounced fashion in small cap, and more broadly speaking across the year, whereas for the quarter, large cap and mid cap were mixed. The reason we talk about quality, this relates to stocks. By quality, we mean companies that tend to have stronger balance sheets, better return on equity, better financial positions, and that tends to be one of the drivers of return patterns over time, and that's why generally we will use a combination of, in a portfolio, include some higher quality managers, because that can dampen volatility on the downside, leads to sometimes lagging returns on the upside when markets are really moving fast and hot, but over the long run helps improve compounding rates and dampen volatility a little bit. In terms of the reality red bonds update for the quarter, here now we have a full year. We can see whereas the trend earlier was higher than this, now the recent months, with the exception of a relatively flat December, were negative given interest rate shifts and expectations of more shifts, and that led to about a 2.65 return, which is not too far off what the overall expected returns are. So kind of a tale of two cities here in this last year. You can expect some more volatility moving forward as rates shape out and likely move up. Hard to know when, however. In terms of investor behavior, similar patterns as usual. There's been outflows out of U.S. equity and essentially flat in world equity, and more money has gone into liquidity and cash and bonds, just in time for some of that bond volatility and missing some of that stock rise. So in general, that's a pattern that happens. People react to markets at the wrong time, or in general react when they should be disciplined in riding through the bumps if they have the asset allocations appropriate for their needs at life stage. Another investor behavior element that we thought you might find interesting, sometimes people refer to the stock market as gambling, when in reality there are very different odds and statistics around that. So if you look at whether it's slots or poker, craps, roulette, whatever you see here, the odds are less than 50% that you'll have anything left over. In other words, there's more than a 50% chance that you'll lose everything. Whereas stocks, as the longer you hold them, the greater the chance of a positive return. But here, even if, for example, in a one-year period, there's a 25% chance of a negative return, that doesn't mean it goes to zero. The market doesn't go to zero. So a very different story, and hopefully this will help some people think about it a little bit differently. This may be interesting as well to 401k plan participants as we do some of those meetings as well. This is the time of year when we update the capital market summary in the form of the periodic table of returns. So don't worry too much about reading the individual numbers and letters here. The big message is that each column is a year from 1997 through 2016. Each color is a different asset class, and what you can see is that over time there's no clear pattern as to what performs well versus relatively poorly. Sometimes there appear to be patterns. If you look, for example, at emerging markets seem to be hot for several years here in the top group in orange, and then boom, was down in the lower range for a couple of years, and then boom, back up to 11% for last year. This happens over and over, and driving using the rear view mirror generally is not a good recipe for success. So this is where the Nobel Prize in Economics was awarded for the idea of combining asset classes to diversify so that you're always holding what's at the top and never having too much of what's at the bottom. And the black box here is a simulation of a 60-40 portfolio using global stock and bond indexes. And you can see that tends to hover somewhere through the middle. There are more stock asset classes on this chart than bonds, which is part of the reason it tends to hover sort of around the range between stocks and bonds. So never at the top, never at the bottom. That's some of the beauty of diversification in terms of avoiding some of that worst case. There's been a lot of talk lately about international being out of favor, and should we hold, and should people hold international stocks? We thought this chart might be interesting to investors in that if you go back to 2002 to 2007, international led consistently 6 years in a row. And people at that time were wondering and asking, should we hold U.S. stocks? Why don't we have more in international? And over time, the patterns tend to reverse themselves. And in the past 6 or 7 years, the U.S. has been stronger. We cannot predict exactly when that will turn, but continuing to hold both provides a scenario where you get the benefits of both in the diversification. And in many ways, you can think of international as being relatively more attractive because it's been out of favor for a while, and almost certainly has more upside over the medium term relative to U.S. stocks, which may have a little bit stretched valuations compared to international. Below here, while of course impossible to read the details, we thought we'd just highlight within international developed countries and within emerging market countries, the periodic table has the same story. Colors and returns are all over the place, only further illustrating the importance of diversification and the impossibility of consistent and accurate predictions of where to be at any given point in time. Now, where to be in terms of travel and fun, that's another story. There's certainly recent currency shifts may be the best predictor of where vacation spots will shift, but isn't necessarily helpful in terms of where to invest. Again, as I mentioned earlier, this is the time of year when the capital market expectations are updated, and won't go into too much detail here except to say that in general, the expectation of stock returns moving forward for 10 years, and this is based on the Callan capital market projections that we obtain through our research partner Callan, indicates using an econometric forecasting model, which is informed both by current patterns as well as long-term historical patterns, that the expectation is that stock returns will drop by about 0.5% per year over the next 10 years in terms of the geometric return. The geometric return incorporates volatility, whereas the arithmetic return might be the expected return in any given year. So you might, over the course of next year, say, well, hey, we got 8.3%. Aren't the Callan projections low? But there may be some other years along that path that have negative returns, which when you compound it and then annualize that into an individual number, it will likely look more like this. In terms of bonds, in general, stayed very similar. You don't expect the magnitude to change as much, but long duration with a shift of 0.5% down relative to the expected return is a more significant shift than 0.5% in stocks. That reflects the interest rate risk and the expectation that rates will rise. Won't go into too much into the others here, into some of those alternative asset classes for now, but we'll mention that volatility expectations have also gone up. So return expectations have come down a little bit, and risk numbers have gone up a little bit. what this means is there's a continued pattern of the expectation that returns will be cooling. There's been a somewhat longer-term trend over the last several decades. This is a chart we showed you at some point last year, around this time, seeing different asset classes here, whether it's non-U.S. equity, U.S. equity, real estate, and so forth, a general downtrend in the return projections over time. And that has also been consistent, if you look in the upper left here, with the downward trend in actual returns using pension fund returns as an example. So there's been a downward trend. Of course, these numbers would look a little bit more even if you adjusted for inflation. But looking in terms of the pre-inflation numbers, there is a downward trend, gradual, that's expected to continue. So there's a chart here in the lower left that we also looked at last year, and obviously you won't be able to read this, but just a reminder that over the years from 1995 to 2005 to 2015, it took an increasing amount of stocks to get the same level of expected return, but that's not necessarily advisable because there is not a one-to-one relationship with volatility. Volatility increases to a greater degree than the return expectation shifts. So this will be important for people to evaluate carefully. Some of the variables that drive the asset allocation decision when we work with clients are really fall into two buckets or columns. One is, what are the capital market expectations? For example, we just talked about the projected returns, projected risk, and measured by standard deviation, and the correlations amongst the returns and asset classes. And then there's your inputs, the things that are most relevant to you, your time horizon, risk tolerance, expected returns, which ties this element into that assessment for you, any asset class preferences that investors have or refuse to hold, and naturally tax status as well. So there are variables on both sides that should, in a well-informed, well-designed asset allocation, that should be part of that decision-making process, and that's one of the areas we help you with and clients with naturally. In terms of the rules and regs corner, IRS contributions shifted slightly in some cases, and in most cases were the same. You can see a blog post on our website that goes into more detail about that. There's questions about the fiduciary rule. What's going to happen next? We also mentioned that the DOL issued new guidance on that rule, but there's also, given the administration change in Washington, big questions about whether or not that rule will even last, or will it be gutted, changed, modified. So there's some uncertainty about that as well. The IRS updated plan correction procedures. You can see that here at this web address if you're interested in exploring that. Social Security cost of living went up a hair, which affects some 401k plans, but most are not affected because most don't have a contribution formula that's integrated with that number. And then in terms of private foundation endowments, while this is more of a reminder than a rule or a reg, but given, for those that are clients that are private foundation clients, the decrease in expected return makes it a little bit more complicated still to distribute 5%. Actual returns in recent years have made that easy because they've been higher than 5% plus inflation. But if you want to maintain corpus and you have to spend 5%, and a projected return, say, of a 60-40 portfolio is about 6% and inflation's at 2%, then if you're spending 5, according to the rule for private foundations, then you might be eroding corpus to the tune of about 1%, just to use some rough math. So we can talk more about that with those clients as we, over the course of the quarter. There's something called OCIO, Outsourced Chief Investment Officer. More foundations and endowments are adopting that type of approach. That's something that we've been doing for a while now in terms of having providing a discretionary option to simplify the job of fiduciaries and foundations and endowments, and for that matter in retirement plans as well. But naturally, we don't take control of the risk profile, but then manage the decisions underneath once the asset allocation risk profile is established. So with that, I want to thank you for joining us today. We are always interested in your feedback. If there are ways we can better support you, questions you'd like to see addressed in these webinars, other topics, or questions you have at any time, please contact us. And we're always thankful for working with you, and also for the people that you have introduced to us over time to help like we've helped you. So again, thank you very much.